Listen up, because I'm about to share with you the single most powerful strategy I use before every recession to not just survive, but to come out richer than when it started. This isn't theory. This isn't something I read in a textbook. This is the exact playbook I've used through 5 major recessions to build my fortune. And right now, all the indicators are flashing red. We're heading into a recession, and most people are going to get crushed because they're doing exactly the wrong things at exactly the wrong time. But you're not going to be one of them, because I'm going to give you the blueprint that separates the wealthy from everyone else during economic downturns. Before I reveal this strategy, let me be crystal clear about something. A recession is coming. I don't know if it's going to hit in 6 months or 18 months, but it's coming. The Federal Reserve has painted themselves into a corner. Inflation is still too high, interest rates are crushing businesses, commercial real estate is collapsing, regional banks are failing, and consumer debt is at record levels. The signs are everywhere if you know what to look for. Yield curve inversions, leading economic indicators declining, corporate earnings warnings, massive layoffs in tech and finance. These aren't random events. They're dominoes falling in sequence, and the last domino is a full-blown recession that's going to catch most people completely off guard. But here's what makes me different from every other financial talking head on television. I don't just predict recessions, I profit from them, because while everyone else is panicking and making emotional decisions, I'm executing a strategy that has made me money in every single economic downturn for the past 40 years. And today, I'm going to give you that strategy for free. But first, if you're serious about building wealth, if you want to be one of the few people who comes out of the next recession richer than you went in, you need to subscribe to this channel right now. Hit that notification bell, because what I'm sharing today could change your financial life forever. Now, let me tell you about my #1 recession strategy. It's not what you think. It's not buying gold. It's not hiding cash under your mattress. It's not even buying stocks when they crash, although that's part of it. My #1 strategy is something I call aggressive cash accumulation with strategic deployment. Let me break this down for you. Most people think cash is trash. They hear about inflation eating away at purchasing power, and they panic into investments that they don't understand. They buy stocks at the top because they're afraid of missing out. They buy real estate at peak prices because someone told them real estate always goes up. They tie up their money in illiquid investments that they can't access when opportunities arise. This is backwards thinking, and it's exactly why most people lose money during recessions. They have no dry powder when the real opportunities present themselves. They're forced to sell assets at the worst possible time to cover their expenses. They miss the buying opportunities that create generational wealth because they don't have the cash to act when everyone else is panicking. Here's what I do differently, and this is the key to my entire strategy. Starting 18 to 24 months before I think a recession is going to hit, I begin aggressively accumulating cash. Not just emergency fund cash, not just 3 to 6 months of expenses. I'm talking about serious cash positions that represent 30, 40, even 50% of my liquid net worth. I do this by reducing my exposure to risky assets, taking profits on positions that have run up, cutting back on discretionary spending, and most importantly, redirecting every dollar of new income into cash positions instead of new investments. This sounds boring. It sounds like I'm missing out on potential gains, but this is exactly the discipline that separates successful investors from everyone else. While everyone else is chasing the last few percentage points of a bull market, I'm building my war chest for the inevitable downturn, because here's what I know that most people don't. The money you make during a recession, buying assets when everyone else is selling in panic, that money compounds for decades. That's where real wealth is created. But you can't just hold cash in your checking account earning 0% interest. That actually is trash, because inflation will eat it alive. You need to be strategic about where you hold this cash and how you deploy it. This is where most people get it wrong, and this is where I'm going to show you exactly what I do. The first part of my cash strategy is to build what I call a liquidity ladder. This means spreading your cash across different types of accounts with different maturity dates and different risk levels. Some cash goes into high-yield savings accounts that I can access immediately. Some goes into money market funds. Some goes into short-term treasury bills, 3-month, 6-month, 1-year maturities. The key is having cash coming due every few weeks or months so I can continuously redeploy it as opportunities arise. When Treasury yields spike because everyone is panicking, I can buy longer duration bonds. When stock prices crash, I have cash ready to deploy into dividend-paying stocks at ridiculous valuations. When real estate markets collapse, I have the liquidity to make all cash offers on distressed properties. But here's the part that really sets my strategy apart from everyone else's. I don't wait for the recession to officially start before I begin deploying this cash. I start buying when prices begin falling, not when they hit bottom. Because here's the truth about market bottoms. You never know when they happen until months later. By the time everyone agrees we've hit bottom, the best opportunities are already gone. This is why my cash accumulation strategy is paired with what I call systematic deployment. As markets fall, I deploy cash in stages. If stocks drop 10% from their highs, I might deploy 10% of my cash position. If they drop 20%, I deploy another 10%. If they drop 30%, another 10%. This way, I'm buying all the way down, which means I'm getting excellent average prices on quality assets. Most people try to time the bottom perfectly. They wait and wait and wait for the perfect entry point, and they end up missing the entire opportunity. Or they panic and buy everything at once when they think it's cheap, only to watch it get cheaper. My systematic approach eliminates both of these mistakes. But the cash strategy is just the foundation. The real money is made in what you buy with that cash, and this is where most people screw up completely. They think a recession means everything goes on sale equally. Wrong. Some assets get destroyed and never recover. Other assets temporarily drop but then explode higher when the economy recovers. The key is knowing the difference. The assets I target during recessions fall into 3 specific categories. And understanding these categories is crucial to executing this strategy successfully. The first category is what I call recession-proof dividend aristocrats. These are companies that have raised their dividends for at least 25 consecutive years, including through multiple recessions and economic cycles. Why do I focus on dividend aristocrats during recessions? Because these companies have proven business models that generate cash flow regardless of economic conditions. They sell products and services that people need even when times are tough. Utilities, consumer staples, healthcare companies, waste management, food and beverage companies. People still need electricity, they still need to eat, they still need medical care, they still generate garbage. But here's the key. During recessions, even these high-quality companies see their stock prices fall because of panic selling and forced liquidations. Institutional investors dump everything to raise cash. Retail investors panic and sell their best assets along with their worst ones. This creates incredible opportunities to buy world-class businesses at recession prices. I'm talking about companies like Johnson & Johnson, Coca-Cola, Procter & Gamble, Walmart, Microsoft. These aren't speculative growth stocks that might go to zero. These are profitable companies with strong balance sheets, established market positions, and the ability to continue paying and growing their dividends even during economic downturns. When these stocks fall 20, 30, 40% during a recession, their dividend yields become incredibly attractive. A stock that normally yields 2% might yield 4 or 5% at recession prices. That's not just a great income stream. That's a signal that the stock is deeply undervalued and likely to recover strongly when the economy improves. The second category I target is what I call distressed real estate investment trusts. Real estate gets hammered during recessions, but not all real estate is created equal. I avoid retail real estate, office buildings, hotels, anything that depends on discretionary spending or business travel. But I aggressively buy REITs that own essential real estate like warehouses, data centers, cell phone towers, medical facilities. These are properties that generate steady rental income regardless of economic conditions. People still need places to live, companies still need places to store goods, internet traffic keeps growing, healthcare demand is recession-proof. But during recessions, even these high-quality REITs see their values fall because real estate as an asset class gets painted with the same broad brush. This creates opportunities to buy REITs yielding 8, 10, even 12% during the worst parts of a recession. Compare that to Treasury bills yielding 3 or 4%, and you can see why this strategy is so powerful. You're getting paid double-digit yields while you wait for real estate values to recover. The third category, and this is where the really big money gets made, is what I call temporary distress situations. These are fundamentally strong companies that get caught up in recession panic, but whose core businesses are actually positioned to benefit from economic weakness. Dollar stores that gain market share when people trade down from higher-end retailers, discount retailers that thrive when consumers become price conscious, debt collection agencies that get busier during recessions, bankruptcy attorneys and restructuring firms that see demand spike, companies that provide essential services to struggling businesses. The key is identifying companies whose revenues and profits actually increase during recessions, but whose stock prices fall anyway because they get lumped in with everything else. This is where you can make 5, 10, even 20 times your money over the course of a few years. But it's not enough to just know what to buy. You also need to know what to avoid completely during recessions. Never buy speculative growth stocks that aren't profitable. Never buy companies with high debt loads that might not survive a downturn. Never buy anything in cyclical industries like construction, luxury goods, travel and leisure. And never ever try to catch a falling knife in the financial sector. Banks, insurance companies, investment firms, these companies can look cheap during a recession, but they're cheap for a reason. They have exposure to bad loans, they face regulatory pressure, their business models get disrupted during economic stress. Leave these alone until the recession is clearly over. Now, let me tell you about the timing aspect of this strategy, because timing is everything when you're deploying cash during a recession. You can't deploy everything at once, and you can't wait for the perfect bottom. You need a systematic approach that maximizes your returns while minimizing your risk. Here's exactly how I structure my deployments. I divide my cash into 5 equal tranches. The first tranche gets deployed when the overall market falls 10% from its peak. The second tranche at 20% down. Third tranche at 30% down. Fourth tranche at 40% down. And I hold the fifth tranche in reserve for truly exceptional opportunities. This approach ensures that I'm buying more shares as prices get cheaper, which improves my average cost basis dramatically. It also means I always have dry powder available if the recession turns out to be worse than expected, or if truly once-in-a-generation opportunities arise. But here's the part that most people miss. You don't deploy cash just based on overall market declines. You also need to look at individual company fundamentals and valuations. A dividend aristocrat trading at 15 times earnings might be worth buying even if the overall market has only fallen 10%. A high-quality REIT yielding 8% might be an immediate buy regardless of broader market conditions. The key is having target prices for specific companies and being ready to act when those prices are hit. This requires homework. Before the recession hits, you need to identify 50 to 100 high-quality companies that you'd like to own at the right prices. Research their business models, understand their competitive advantages, calculate what you think they're worth. Then, as the recession unfolds and prices fall, you can act decisively instead of trying to figure out what to buy in the middle of a crisis. When everyone else is paralyzed by fear and uncertainty, you're calmly executing a plan you've had in place for months. But the deployment strategy goes beyond just buying individual stocks and REITs. You also need to think about asset allocation and portfolio construction. During the early stages of a recession, I keep my allocation heavily weighted toward defensive assets, the dividend aristocrats and essential real estate plays. As the recession deepens and truly exceptional opportunities arise, I gradually shift toward more aggressive positions. Distressed debt situations, turnaround plays, companies that are temporarily impaired but likely to recover strongly. This requires careful analysis and strong conviction, but this is where the biggest returns are generated. The other crucial element of my strategy is knowing when to stop deploying cash and start taking profits. This is actually harder than it sounds because the best opportunities often arise when things look the most hopeless. But you need to maintain some cash reserves throughout the recession for unexpected opportunities and to ensure you can cover your personal expenses without being forced to sell investments. My rule is simple. I never deploy more than 80% of my total cash position, no matter how attractive the opportunities look. That final 20% is my insurance policy against being wrong about the timing or severity of the recession. It's also my seed capital for the next opportunity cycle. Now let me tell you about the exit strategy, because knowing when and how to take profits is just as important as knowing when and what to buy. The biggest mistake I see people make is falling in love with their recession purchases and holding them too long. You buy these assets because they're temporarily distressed, not because you want to own them forever. My exit strategy has 3 phases, and understanding these phases is crucial to maximizing your returns. Phase 1 begins when the overall market has recovered 50% from its recession lows. This doesn't mean the recession is over, but it means that the easy money has been made and it's time to start taking some profits. During Phase 1, I sell my most speculative positions first. The distressed debt plays, the turnaround situations, the companies that benefited from temporary recession dynamics. These positions have typically given me the biggest returns, and they're also the most likely to give back those gains if I hold them too long. I take these profits and move them back into cash or short-term treasury bills. This gives me flexibility for the next cycle and ensures that I lock in the extraordinary gains that these crisis purchases generated. Remember, the goal isn't to maximize every last dollar of profit. The goal is to consistently compound wealth over multiple cycles. Phase 2 of my exit strategy kicks in when the overall market has recovered to within 20% of its pre-recession highs. At this point, I start selling my REIT positions and my more cyclical dividend stocks. Real estate and cyclical companies tend to overshoot on both the downside and the upside, so I want to capture that upside momentum before it reverses. The dividend aristocrats, the truly defensive companies, these I might hold longer because they tend to continue performing well even as economic conditions normalize. But I'm still taking partial profits to reduce my position sizes back to normal portfolio weightings. Phase 3 is the complete reset. When the market reaches new all-time highs and everyone is talking about how the recession is a distant memory, that's when I complete my exit strategy. I sell the remaining recession purchases and go back to my normal asset allocation. More importantly, I start building cash again for the next inevitable downturn. This disciplined approach to profit-taking is what separates successful crisis investors from everyone else. Most people get greedy, they see their recession purchases doubling or tripling in value, and they convince themselves that the gains will continue forever. Then they ride them all the way back down during the next crisis. I've seen this happen over and over again. People make fortunes during one recession, then lose it all during the next one because they never took profits and never rebuilt their cash reserves. Don't let this be you. Discipline beats greed every single time in investing. But let me tell you about the most common mistakes people make when trying to execute this strategy, because avoiding these mistakes is just as important as doing the right things. The first mistake is starting too late. By the time the recession is obvious to everyone, the best opportunities to build cash are gone, and the best buying opportunities are much more limited. The second mistake is not having enough cash. People think 10 or 20% cash is enough. It's not. During a real recession, you need 40 to 60% of your liquid net worth in cash to take full advantage of the opportunities. This feels uncomfortable when markets are rising, but comfort is the enemy of wealth creation. The third mistake is trying to time the perfect bottom. People wait and wait for prices to stop falling before they start buying. By the time they get comfortable, the recovery has already begun, and they've missed the best opportunities. Remember, you're buying on the way down, not at the bottom. The fourth mistake is buying the wrong things. Not all cheap stocks are good investments. Companies go bankrupt during recessions. Entire industries can be permanently disrupted. Focus on quality businesses with strong balance sheets and essential products or services. The fifth mistake is not having an exit strategy. People get so focused on buying during the crisis that they don't plan for what to do when the crisis ends. Without a clear exit plan, you're likely to hold too long and give back your gains. The sixth and most dangerous mistake is using borrowed money. Never, ever use margin or leverage when executing this strategy. Recessions are unpredictable. They can last longer and go deeper than anyone expects. If you're using borrowed money, you can be forced to sell at exactly the wrong time. Now let me give you the specific action plan to start implementing this strategy right now today, before it's too late. First, calculate your current liquid net worth. This includes cash, stocks, bonds, anything you can convert to cash within 30 days. Don't include your home equity or retirement accounts that you can't access. Second, start building your cash position immediately. Your target is 40 to 60% of that liquid net worth in cash and cash equivalents within the next 12 months. This means reducing your current investment positions, cutting discretionary spending, and redirecting all new income toward cash accumulation. Third, set up your liquidity ladder. Open high-yield savings accounts, money market accounts, and start buying short-term treasury bills with staggered maturity dates. You want cash becoming available for deployment every few weeks so you can act quickly when opportunities arise. Fourth, create your target list. Research 50 to 100 high-quality dividend aristocrats, essential REITs, and recession-resistant companies. Calculate what you think they're worth and set target purchase prices at 20, 30, and 40% discounts to current market values. Fifth, practice systematic deployment. Don't try to time the perfect entry points. Plan to deploy cash in stages as prices fall, which improves your average cost basis and reduces your timing risk. Sixth, plan your exit strategy before you need it. Decide in advance what market conditions will trigger profit taking and stick to that plan even when it feels uncomfortable. Here's the bottom line. This strategy has made me money in every recession for 4 decades. It's not complicated, but it requires discipline, patience, and the courage to act when everyone else is paralyzed by fear. Most people lose money during recessions because they do exactly the wrong things at exactly the wrong times. They panic, sell their best assets to raise cash when prices are low. They avoid buying opportunities because the news is terrible and the future looks uncertain. They make emotional decisions based on fear instead of rational decisions based on mathematics and history. You're going to do the opposite. You're going to have cash ready when everyone else needs cash. You're going to buy when everyone else is selling. You're going to stay calm when everyone else is panicking. And you're going to come out of the next recession significantly wealthier than when it started. But you have to start now. You have to build your cash position while markets are still high and opportunities are still limited. You have to do the homework and create your target list while you have time to research properly. You have to develop the discipline and emotional control that this strategy requires. If this video has given you a clear action plan for the recession that's coming, if you're ready to stop being a victim of economic cycles and start profiting from them, then I need you to do 3 things right now. First, smash that like button to tell the algorithm that this content needs to reach more people. Second, subscribe to this channel and hit the notification bell because I'm going to keep sharing the strategies that actually work, not the feel-good nonsense you get everywhere else. Third, leave a comment below and tell me what percentage of your portfolio is currently in cash. Be honest. Most people are going to realize they're completely unprepared for what's coming, but now you have the roadmap to change that. Remember, recessions don't destroy wealth. They transfer wealth from people who are unprepared to people who are ready. Which category do you want to be in? The choice is yours, but you have to make it now, before everyone else figures out what's happening. This is your opportunity to build generational wealth. Don't waste it.